Well, when investing in shares, you obviously are drawn to the best performing stocks. That's often an emotional reaction. Olof Bergh, analyst at Sanlam Private Investments, has some advice for people who do that, and he joins us now for more. Good morning to you, Olof. It seems the natural thing to do when a share is doing well that you want to buy it, and that's the problem, isn't it? Because it often, by the time everyone's buying the share, it doesn't offer the value that it used to. How should we be thinking about this?
Morning, David. Yes, you summed it up well. The big pitfall many investors fall into is investing in shares where the momentum is behind their share, and the general investment story is good, but the investment case is often not good. And the reason the investment case is not good is that good operational performance does not always last into perpetuity. However, when the market prices the share, it often prices the share as if the good investment case will perpetuate, so will last into perpetuity. So generally what we do at Sanlam Private Investments is we try and generate through this cycle what we call a normalized intrinsic value for the share, which essentially normalizes the profitability generated by the share. And in so doing, we generate what we feel is a more true reflection of the share's true intrinsic value and guides us in our decision making.
Olof, this is Nozi sitting with David in Johannesburg. Just a quick one on cyclicality. I mean, most industries go through some degree of cyclicality from time to time. How should one be thinking about this, and how should you be approaching investment at a time when an industry is at different stages in that cycle?
Well, firstly, I think it's important to recognize that cyclicality is very normal. It's an absolutely normal economic process which repeats itself time and time again, and it's driven by a very basic economic force, and that's the hunt for return. So just to elaborate on that, when companies are doing very well, for example, generally capital will flow towards that industry to capture those returns generated in those industry. That would alter the supply and demand dynamics within the industry and normalize the returns, so reduce the returns because supply of the particular product or good picks up and the so-called equilibrium comes down. Of course, the converse is also true. So when companies are enjoying, or not just companies, when industries are not enjoying good returns or delivering poor returns, generally capital or capacity, put in a different way, will leave the industry, changing the supply dynamics, and returns will rise, and generally they don't just rise back to the normal level. Generally, because people over-respond and because of the nature of the economy, it generally overshoots on either side. So with that in mind, we've always got to remain cognizant of how the market is pricing a particular industry or share and put that into context of the overall cycle and the nature of cycles. So maybe to provide an example of the retailer shares over the past 2 years, being 2011 and 2012 and 2013, the operating environment was fantastic. The shares were generating very good returns on capital, and the share prices were responding positively. However, at a point in time in that uprun in the share price, they became so expensive that the market's expectation was for the share to remain in those super profitable stages for a very long period in time. The economy has subsequently cooled somewhat. Consumers are under pressure from varying fronts, and the retailers, being the fast-moving consumer goods retailers and the more discretionary retailers, are taking strain. There's more competition because they were generating high returns, so they all pushed to up their store frontage. They all pushed to increase their brand offering, and at the same time it was coupled with a weakening in the consumer, and at the moment the profitability is certainly on the decline, and the share prices responded. The share prices are down some 20% since the highs recorded in last year.
Yeah, Olof, the cycle is one thing, but of course there are companies that are not perhaps counter-cyclical or cyclical, but anti-cyclical in the sense that they just keep on going. And you think of a share like Famous Brands, for example, which has just put out an announcement this morning about more expansion into Africa. Because they grow organically and by acquisition, they can defy the cycle completely. How do you react to that? And that then comes back to the quality of management and different kind of analysis, doesn't it?
Yes, David, sure, absolutely. There obviously are exceptions to the rule. There generally are companies within a particular index which will, through the cycle, perform better. It's very difficult to quantify those type of companies, to quantify the quality of management, but you do, to a certain extent, incorporate those other factors into your analysis as well. But as a starting point, we generate a through-the-cycle intrinsic value for any given company, and the through-the-cycle intrinsic value does incorporate qualitative factors like management, like historical deliverance ability of the particular company, and so forth. So whilst everything in investing is not quantifiable, we do try, in the generation of our intrinsic value, which guides our overall investment decision, try and bring into account the more qualitative factors into reckoning.
That's a good place to end it. Thanks to Olof Bergh, who is analyst at Sanlam Private Investments.